This is Stratton Park Apartment. It is in San Antonio. And a few disclaimer, it is a 506c investment, which means you have to be an accredited investor to be able to invest in this deal. So you can talk to us later about, we're going to also discuss how you can get your accreditation letter in the future. Other disclaimer, we're not a tax advisor. We're not your financial advisor. So this is just for informational purpose only. And before you do an investment, you should read all the private placement memorandum, and you should consult your lawyer, your CPA, or whoever needs to be contacted before you do. I was saying that I love this deal very much, and there's many reasons why we love this deal. Number one reason, for those that already saw the video that I sent out in the group, is this deal, this property was bought in 2024 by another group, and they bought it for over $13 million. And we are going to be buying it $3 million less than they bought it for. And this has to do with the bridge loan that they got that ended up being called. So we're buying it for essentially the price of the actual loan. So right there, there's already value straight up right in there. And also, when they did the appraisal, the county, which usually actually on the lower side, we're still buying it for $800K less than the appraised value. So no matter how you slice it or think about it, so we are coming out ahead by just buying low on this deal. So another point to mention, we always talk about the importance of off-market deals. Like when you want to do deals, when the deal is on the market, it's already too late. And that's one of what you have to deal with when you're a beginner. Most of your deals is going to be on the market, and many times, many syndicators already look at the deal. They already passed on the deal before you seen the deal. So in this case, we had enough time to negotiate because it was truly off market, and we're like working with them until we're able to get the deal done. So we were not really competing with anyone. So usually they reach out to us, and then we'll try to see if we can make a deal. Okay. So another thing that we decided, we've done so many deals in the past, and we like to get properties like above 1980. That's one of those metal pipes, so many deferred maintenance when you get below 1980. So, this is a 1985 asset in San Antonio, and it's a very desirable market. So at the end, we always talk about location. So we're going to discuss more later on why this location is a very perfect location for us to acquire. So another thing which is even impressive to me is the fact that we're able to get 5.3% fixed debt rate. So we all know most of the issue with many of the syndication that went under were because they had a variable rate. Despite the fact that people are predicting that interest rate might be going down, we've seen what is happening in the market, that with change in politics and everything, that the interest rate might not go down or as fast as we thought it's going to be. So despite that, we are able to secure a loan, and this is based on our experience. By all the members of this team putting our experience together, they were able to give us a good rate. And also, we have a deal that is already cash flowing. So this deal is going to cash flow day one, and we're going to be showing you the numbers. And this is because if you have low debt, you're buying in cheaper, and then you're buying in a good area. As long as you keep your occupancy up, it's a no-brainer. It goes without saying. So why multifamily investing? And we do a lot of real asset investment. We do self-storages, we buy businesses, we do oil and gas. But why do we do multifamily? Because some of them might get a higher return, but yes, we stick to multifamily as our base. When people are going to build a pyramid for their finances, I always tell them to start with multifamily as their base. So you want to get that bottom of the pyramid to be mostly multifamily. After those are doing well, you can start doing a little bit more asymmetric upside plays above that, okay? But you can always fall back on this multifamily. That's the way I look at it. And the few reasons are everyone is going to have to find a place to live, regardless. So it's going to always be a need. So you want to invest in things that, especially if you're thinking that there's going to be recession, or you're thinking that the economy might not be stable. So you want to invest in things that people are going to use every day. So one of them is multifamily. Another thing is the multifamily performed very well, if not the best, among other asset classes in terms of risk adjustment. And there's only very few things in this life that produces cash flow, equity appreciation, and give you depreciation as tax benefit. So it's basically you're winning in all areas with multifamily. So we love it. We love business. You can cash flow, get a lot of money very quickly, but you can also fail very quickly. Multifamily is like that middle of the road in which if you get good team and you stick with it, usually you're going to come out ahead. This is a very common thing people say all the time. I wish I had bought in 1930. I wish I had bought in 1940. Oh my God, you're buying it for 100,000 house in New York City, a whole apartment complex. And I'm like, you're going to say the same thing in 20 years. You're going to go back again. I wish I had bought in 2024. I wish I had bought in 2025. So just buy now. So at the end of the day, there's no need to think about World War I or II. Just buy now. Most of our people here already know about multifamily, so I'm not going to go too deep into the point. It's just usually stable, an asset class that is well known. Almost every billionaire, in one way or the other, make money, some of the money through real estate. So I already talked a little bit about myself, and I'm also a father and a husband. I think of investments personally when, forgive me, I know you're the military guy, but I always think of it more, not more like a machine gun, but more like a sniper bullet, in which you only have few of it. And you want to make sure that, if you're going to use it, it's very purposeful, because if you have 100K to invest, you're not going to just put it anywhere. You only have one or two investments that you can put in for the year in terms of real estate. So then you have to pick carefully. So that's just something that I always keep in mind personally. So a member of our team, so we have more people, but this member of the team that's going to be involved in this deal from Dr. Breathe Easy Capital side, we have Charles. Charles is going to be talking about San Antonio in the next few slides. And because he lives closer to the area, he's going to be one of the boots on the ground. He's also one of our investor relations, and he loves to do underwriting. So every single deal that come across my table, after it's gone through the basic underwriting, it goes through Charles, and he's going to take a look at it. He does have his own multifamily portfolio, single family and multifamily, and he can introduce himself briefly again later. We have Ola. Ola is an entrepreneur, over 10 years in real estate. He does his own development personally, and I do like to rub some ideas with him here and there. He's on the board of my director in general, so whenever there's things we need to improve in Dr. BDZ Capital, I call Ola and few people that I trust. So he's also part of the investor relations team, which is going to be talking to investors and answer questions and helping us on that in that aspect. I have Dr. Obi. He's like I said earlier, he's been investing with us since 2020. He's done self-storage, he's gone through the ups and downs with us. And then the fact that he's stick around and also helping us educate other people and also talk to other people about our investments, talks about his belief in the company and also in what we do. And then we have Josh. Josh is our acquisition manager. He's not the one that did this particular one, but he also goes through many deals that come through us. He's a broker. So he's the one that kind of help us look into the deals to make sure that we're getting good deal. He also helps with the sales because he's a broker. So that's about it. This is Wayne. I'm gonna just say a little bit about him, how we came together mostly. He's gonna talk about himself when he's gonna be present later on in the future. For now, so I met Wayne through another friend, a trusted friend syndicator, Dr. Raj, who is also part of the team that's going to be doing this deal. And we talk back and forth, and I look at his portfolio and was impressed with what he's done. And also, you're going to see when he talks, you're going to find out exactly why. The guy is a likable guy. Main thing is the fact that this is all he does. And I like to partner with people like that, despite the fact that I claim myself to be someone that is very diversified and able to do so many things at once. You still need people that this is all they do, 100%. In fact, I would advise you not to invest in deals where you don't have boots on the ground, whereas there's someone who's this is how they feed their family. And I like that. And the way he talks is very passionate. Look, guys, where's that $5? When we go to the meetings, he will track down every dollar. And he has over $50 million assets under management. And many of these deals are in Texas, okay? Most of them actually. So that's one of the reasons why we like boots on the ground, people that live close to the area. I'm here in Fort Smith. I'm not going to be able to manage all the way from there. So he's the main guy on this deal. Okay. We also have Dr. Raj, that I talk about. He also has his own station company, and he has over 2,000 apartments under management. We have Donald. Donald, I met him during one of our mastermind. At one point, I was looking for different mastermind groups, and I met him in one of the mastermind group. And I like the way he thinks. And so since that time, we've maintained communication. Whenever there's a deal that both of us love, then we do them together. And then we have David Priest, who he was part of the last deal also in over 20 years as a real estate professional in Texas. So another thing, boot on the ground. And also he has over 600 units of apartments. With this, it's going to be 727, right? Units under management. So we have experienced team on board. And so I'm going to give it to Charles. And Charles is going to talk a little bit about the San Antonio market and why it's a very good place to invest.
Awesome. Thank you, Dr. Bio. Good evening, everyone. My name is Charles Nunu. I currently live in Houston, Texas. I am an engineer. Throughout my career, I've had jobs in the oil and gas industry, real estate and development, in the tech world, and then most recently, the data center industry. So anything you hear about AI, GPUs, I built the data centers for those. So let's get into it and let's talk about San Antonio. So I went to college at UT Austin, and my first job out of college was headquartered in San Antonio. So I'm very familiar with the city. I love San Antonio, and as we know, the Alamo is located in San Antonio, and it is part of the rapidly growing Texas Triangle, with San Antonio having the largest population growth in 2023. So 2.7 million people call San Antonio home, making it the second largest city in Texas, which I was actually surprised. So it is larger than Dallas, okay? It's the seventh largest city in the US, number one ranking according to US Census for fastest growing metro. In 2023, they added 22,000 people to their population, and the population is expected to grow to 3.5 million people by 2034. Employment growth from 2014 to 2024 has been 25.2%, over 10 percentage points higher than the national average, indicating a solid job market. All right, next slide, please. All right. San Antonio has shown strong performance over the last 10 years, outpacing numerous growth markets in percentage population. and employment growth. Houston is a market that we're bullish in, and we've been buying in for a while, but we've been seeking to break into the San Antonio market for a little while now. With 18% population growth in the last 10 years and 25% employment growth over the last 10 years, it's comparable to the Nashvilles, Charlottes, and DFWs out there. All right. As mentioned earlier, it is the fastest growing city in Texas with the metro size twice that of Chicago. And it actually has a larger population than the entire state of New Mexico. It has a diverse economy with several industries, including tech, healthcare, and the military. And it's home to a five-time NBA championship team, the San Antonio Spurs, with two major amusement parks. They've added over 36,000 jobs in 2023 and a top tourism hub with 40 million visitors annually. And it's home to Joint Base San Antonio with 80,000 personnel. All right, next slide. So San Antonio has a global presence with $580 million in exports in 2024. It shows strong trade ties. 11 million passengers have passed through the San Antonio International Airport in 2024. Toyota's $531 million expansion added 400 plus jobs in the San Antonio metro. Several consulates are located in San Antonio, including Mexico, Japan, the UK, and it's home to 6 Fortune 500 companies. It has 47 nonstop flights throughout the US, Mexico, and Canada, and it's home to over 400 companies with global operations. All right. We are going to continue to see San Antonio grow over the next 5 years. This chart is according to JLL, and with 5% and 13% employment and GDP growth respectively. We hear a lot about Vegas, Phoenix, and Raleigh, where you can add San Antonio to that group and to that mix when you have those discussions as well. All right, next slide. All right, so if you're not familiar with San Antonio, it's located southwest of Austin, and the Stratton Apartments itself, the subject property, is located in the great area of north central San Antonio called Arboretum. Okay, so that's Arboretum is a submarket, and the property itself has easy access to Highway 281. The property is 7 minutes from the international airport, at 17 minutes from downtown San Antonio, and it's 19 minutes from Six Flags Fiesta, Texas. It's also walking distance to both an H-E-B and Target. So it's in a great location and in a great submarket. All right. So now let's talk about the Arboretum submarket itself. So within Arboretum, we have over 29,000 employees and over 2,800 companies. 47% of the population hold college degrees or higher. And with a 49% ratio of rental households, it has a strong rental market. It's located in a strong rental market. Another thing that we look at is supply of what's coming online in the next few years. Throughout 2025, we're expecting 350 additional units with no new starts. If you look at the submarket occupancy rate, it's a little bit lower than the subject property. We're at 90% and the submarket is at 86%. But as those 350 units come online, become occupied, and with no new supply and continued population growth, we're going to see that occupancy rate increase. So another thing that we look at also is the crime report. With this ranking of 37 out of 100, it is a very low crime area. So we really like that. Population within 1 mile of the subject property is over 7,500 people and over 83,000 people within 3 miles. We expect a 5.58% population growth over the next 5 years. And median income is $64.6 thousand per year, which is great compared to the rental rate. So we have a good income to rental ratio there. And with the daily rent per square foot of $1.49. So between the close proximity to the airport, low crime, numerous office and residential buildings, and abundant retail and restaurant options, it's going to make North Central San Antonio a highly sought after area. And it's just going to be a great place to live.
Okay. Thank you, Charles.
Yes, sir.
And yeah, San Antonio, we don't even have to really say a lot about it. For people that don't know, it's a great place to live. I'm going to give it to Wayne to introduce yourself, and then you can go over the actual presentation. I like Wayne doing this part because he is very passionate about this, and he found the deal himself. He was the one that was like talking back and forth over many months to get this deal done.
Yeah, absolutely. Thanks, Bio. Thanks, Charles. Great job with everything. So I'm super excited about this deal. When it came to me from a broker relationship, it wasn't on market or anything. It was just relationships and them knowing that we're actively looking in San Antonio. It really worked out great for us and for y'all as investors. Stratton Park Apartments is 127 units, Class B in a Class B area. It's a mixture of 72 one bedrooms and 22 two bedrooms. And then if you were to go to the property, it's two properties on the same road. So you have one that's the main buildings, which is the 72 unit, one bedrooms, 22 two bedrooms. And then about 300 or so feet on the other side of the road, you have one bedroom and two bedroom townhomes with its own pool. So it's nice because you have the apartments and then you have townhomes all together, obviously, our Stratton Park Apartments. So there's a lot of good options for renters in that area. It's all two-story garden style. There's 13 residential buildings, one leasing office. Rents range from $789 to $1399. And one of the slides later on, we'll talk about the median income, but it's about $64,000 median income in the area. And so it well supports rents and the growth. We'll also on a later slide talk about the area comps and how we're able to push rents while also retaining existing residents, et cetera. If we go to the next slide, and some of these, all these pictures of Stratton Park, so we have a lot of them in the slide, but we already mentioned the 127 units. The thing about this property is a lot of the work, for example, like the roofs are in great shape. We had our due diligence process where we have our plumber, electrical, like the plumber, they run cameras through all the plumbing lines. And so we know that there are some areas that need repair, but it's nothing major. It's PVC. One of my first properties had cast iron plumbing. And if y'all ever get cast iron plumbing or see that in a slide, like run, because it always corrosion and just crazy repair expenses. But yeah, it's PVC piping, which is great. Copper wiring, like I said, pitched roof. So the roofs are in good shape. There's some wood siding on the townhome side that we've got budgeted to repair, but we're not going to be going in and doing major interior renovations, spending $8,000 to $10,000. Like the units are in overall good shape. And what I find is if I can get 3 to 5% rent bumps from existing residents, and people are like, how do you get 3 to 5% rent bumps? And I'm like, we actually get 5 to 7 across our portfolio. And the reason is like if someone's rent is $799, a 3 to 5% increase is really like $30, if that. So if you're already below market, where are they going to go? And especially if you're adding value to the community, being good stewards, being good managers, and not just like pushing rents. And we want to have a good community as well. And so it's just a mixture of like it costs more to move than pay $30 more a month. And if you were to move at one of the competition buildings, you're going to be paying market rent. So that's how I feel very comfortable doing the 3 to 5% rent increases. And then we have MLDC, our property management team that manages our portfolio and has just done an incredible job of watching and really leasing up to the right people. So we don't have as many evictions. We don't have as much bad debt in apartments, no matter if you're class A, B, or C, like you're going to have those things. But if you can limit it by doing the right screening processes early, it really helps the long term of the asset. And that's what we see across our portfolio, especially recently with Courreges that we acquired back in August with Dr. Bio. There's 2 pools, 2 pet parks. There's sidewalks, 24 hour access, outdoor grills. It just, and I don't know, for those that are in the San Antonio area or Central Texas, there's so many beautiful live oak trees too. So it's just a really great ambiance of the property. I already mentioned coppered wiring, HVAC, roof, plumbing. All those inspections were done. We spent 2 days walking every single unit, having all those professional companies come in and do the inspections. We spend all that money for those inspections. Those aren't free up front because we want to know what we're getting into. So that way we can ensure we have capital reserves as part of reducing the risk for you as an investor. The other item too is that we have our property management company, MLDC, they do lease audits. So while there's typically 2 or 3 teams that go inspect the property, we're walking alongside them, going into these units. And then we have a separate team that's going through all the lease files, comparing it to the rent roll, comparing what was the background check. It just make sure everything ticks and ties. It amazes me how the rent roll shows all these residents and sometimes there's no lease even, or it's mind boggling, but everything checked out pretty nicely on this. Even though and it's unfortunate, nobody wants anybody to be in distress or have issues. The portfolio for this seller, unfortunately, the loan is being called due, but the property itself is not distressed. It's 90% occupied. Collections are or bad debt is super low. We're grateful. It's almost like we're getting a great opportunity, even though it's distressed portfolio wise, but we're not seeing that at the local. Some of the add-ons that we want to do is washer and dryers. Whether we do that ourselves, where we put in new washer and dryers, pay 100%, and then all that cash flow from rental goes to us, or what we did at Candle Ridge is we worked with a leasing company that charges maybe $50 to lease a washer and dryer a month. And then we bill back $15 more. So it's $65 for a washer and dryer. So we profit off that $15 without actually having to spend the upfront capital. And then more importantly, we don't have to do the maintenance. So it's again, additional revenue. We are going to be repairing one of the pools and doing some exterior, but it's all low hanging fruit. It's nothing major. And then we still have reserves for if there were anything major that comes on during our ownership. All right, we'll go to the next slide here. And by just let me know, do you want me to keep going through the slides? Just let me know if you want me to stop because I can keep going.
Yeah, if you guys have any questions, ask it in the chat and then we can answer it as we go along.
Here. Happy to have the conversation. So the FEMA flood map, guys, that is one of the first things I look at. A lot of times because we definitely invest heavily in Houston, but San Antonio, anywhere. It's real estate is already a risk. Why add more risk by having your property in a flood zone? So this is just an example of doing due diligence of making sure, okay, we're not in a flood zone. If our properties touch a flood zone or in a flood zone, we pass. All right, we'll go to the next slide. All right. I've never seen something more greener in my life when buying a property. Most of my stuff is in yellow, light red. There's some crime. Like it is what it is in multifamily. This is like super green. We are super low crime, super good area. And anyway, so I think that's really a great thing about this property at Stratton Park. MLDC will manage the property. They're based out of Houston. And they have a regional manager in the area. And so we're excited to grow with them there in San Antonio. The thing about MLDC that I really is that they're boutique enough where I know the owners. Like if there's an issue, I'll call the owner and we'll have that discussion and we walk through it. But it's not like one of those big management companies where I'm like a number. I don't want to feel like a number. I don't want the regional to have 20 properties. And I've had that issue where it's like they're so busy. And then they tell you on the phone, like, hey, I've got 20 properties. I'm working on financials. I can't help you right now. I'm like, that's not good for me. And so I don't get that with MLDC. Their regionals max out at 7 properties. And then you have your on-site property management, your on-site maintenance. They're just an outstanding group, great culture. So we're excited to have them there at Stratton Park. You can go to the next slide. All right, so let's talk about the deal breakdown, sources of funds. So the total loan is $6,987,500. Our investor equity portion will be $5.2 million, and how those funds are broken out are as follows. Dr. Bayo mentioned earlier that we're pretty much buying it at their debt. Their debt is about $10.2 million, so they get a little bit more. But really, after they pay the broker fee, and I'm sure there's some legal fees, et cetera, that they'll be paying title, some closing costs, we're pretty much breaking even on the debt side. So the site acquisition is $10,750,000. Again, about $3 million less than what was purchased last year. Capital expenditure and reserves will have $764,250. And I'm one of those owners, and Bio can attest to this on our weekly calls. Like we do not spend money unless we have to spend money. There's 2 reasons to spend money. It drives revenue, so there's net operating income, or we've got to do maintenance. But we're not going to go in and just paint everything, just say we painted everything or do all the stuff, because at the end of the day, most of these residents just want a safe and affordable place to live. And by the way, that's how people get in trouble, because they spend all this money and then in year 2, year 3, they don't have any reserves. So we have a good plan, but that $764,000, like most of it is contingency for things that may happen. And we've got to prepare for that. We got to do maintenance and take care of things that are required, code related stuff. There's nothing that I see that's against code, but that 764,000 is a tight, I'm extremely tight about our money. And we have a full-time, one thing Bio didn't mention is we have full-time employees at CREI Partners. So not only in myself, but we have a full-time senior asset manager. That asset manager is based in Austin and travels to our properties monthly, but they have weekly calls. And those costs and those expenses we just treat it, everything. We just run pretty tight ship on expenses. But acquisition fee, we've got loan fees, closing cost. And so this slide just breaks down on how these funds are being used as we close the deal. So again, 10,750,000, the price per door, 84,649. This is to me like mind blowing because I don't know, a couple of years ago, prices were just crazy. 2-3 years ago, prices were crazy. And I think this is like the story we've been waiting for. This is one of those deals. Everyone's like, hey, we've been waiting for a distressed deal. We're waiting for all these opportunities. It's going to happen. In this case, it's not a distressed deal, but as I said, it's overall in a distressed portfolio. So it's fantastic for us. And so super excited. It's a 7-year fixed rate. This is not a seller financing deal. I apologize on this slide. This is a Fannie Mae fixed rate debt. And I think that's really important because Fannie Mae, they do their own due diligence and they underwrite very meticulously. They don't want to be in a deal. The government doesn't want to be in a deal that numbers don't work. In my mind, I love Fannie Mae loans. We just finished one with Kendall Ridge. Like we love Fannie Mae. And Bio can attest. Yeah, going through the loan, they like scrub and know everything about you. You feel violated at the end of it because you're like, damn, like I wasn't supposed to know. But anyway, this is part of the process. And I think it's good, really good. And so it's just another layer of review and underwriting by professionals. So that is a Fannie Mae fixed rate, 65%. And I find that really important that 65% the loan to value is important because we're not overly leveraged. If we look in a later slide, they'll show a break-even point. But if we over leverage, that break-even point is higher, higher. And you want that to be as low as possible. Not that we want 40 units to be vacant, but it provides security and preservation of cash in case the market outside of San Antonio's control, outside of anybody's control, we can still pay our debt service. We can still take care of our investors. So that thing is huge as well. Now, this interest only may increase. It may be a 3-year interest only, but for right now, I'm putting a 2-year. So that's something that we're going to continue pushing on the interest only. All right, we'll go to the next slide. All right, so let's talk about rent comparables. So what you want to look for mostly is in the top or the bottom right corner. This is the subject property, Stratton Park, the 1-bedroom, 2 bedrooms, but I'm going to look at the total average was $1.43 a square foot. And then if you go to the next slide, the nearest competition is Altamonte, and it's a beast. It's 432 units. And their total average is $1.60. And I think that's huge. If their property is 432 units, and when I went a couple of times, they only had a handful of units available. And they're pricing higher than we are just right down the road. So I think that's a really good base. These other properties, 0.3 miles was Altamonte. Harper at the Park is 0.7 miles. They're at $1.42 a square foot. If you go to the next slide, we've got a couple more comps, Arbor Hill and 550. So Arbor Hill is at $1.36 and 550 is at $1.52. One thing that Charles had mentioned earlier is we have some supply, and it's something we do need to talk about on these calls, is that Austin, San Antonio, a lot of these growing markets, Houston even, there's supply that's coming in. But that's okay. And that's fantastic because once the supply gets absorbed, and why we look at that city population and why we love San Antonio is because these cities are absorbing. There's new people moving in, there's job growth. And then there's no new development permits, maybe one-offs. But if you think about it, if we're buying now and the absorption happens over the next year, maybe worst case 2 years, and there's no new properties coming online, that's going to tighten the market and supply is going to be extremely tight. Demand's going to be high. And that's where we see the rent increases. And then guess what? Rent increases produce developers' excitement to come back into the market and start developing against these cycles that we see in real estate. And so anyway, so I'm super excited about that. But the overall, what matters on these slides is our subject property, Stratton Park Apartments, is $1.43 a square foot, and our comps average is $1.49. So when I look at that 3 to 5% increase, it's not overly aggressive. It can happen just by, taking care of our residents, building a solid culture, and realizing like these rent bumps really aren't that much, because if they want to be in the area, where else are they going to go? Because it's going to be higher elsewhere. Now I'm going to try to zoom in a little bit. Look, our underwriting, yeah, it's okay. So the underwriting, we're very transparent and open to sharing any of this. So if it's hard to read numbers, we can go through it. Dr. Bio can go through it as well. But what I have here is annual rent growth, 3%. Now, the current market rents, where total effective growth income is $1,496,000. So that's my year one. That's less than the T12, which is to the left of it, at $1,503,000. So I'm assuming that we are going to do worse than this manager in year one than the manager whose overall portfolio is in distress is doing. Now, by contrast, one of the things that we do with MLDC is they do their own underwriting. We never share our underwriting as an owner. We always just show us what you got. What do you think is going to be? Their income is over 1.5. It's like 1,557,000. My number is 1,496,000. Now, I don't change my numbers to match property management because I stay conservative. And I think they could be onto something. But when I meet with them every week, or our team member Will does as well, that's the number, that 1,557,000. That's the number we're targeting on their side. But in the background, for our returns and for our being conservative, that 1,496,000 is what we're targeting. Now, it does go up year two. We're expecting loss to lease because as we turn units, we're going to get more to the market rent. The vacancy loss stays 10% throughout. We expect rent concessions. We expect some bad debt. Like, those are things we do expect just because of the market. Now, hopefully in 3-4 years from now, we won't see as high a vacancy because the supply is tightened. But for the purpose of underwriting and staying conservative, we're keeping it consistent year over year. The other thing on this slide is reimbursed utilities. We're keeping that stable year one. And then in year two, what we notice is they weren't even billing back all the water. And so as leases happen, or renewals happen, we're going to capture those water billings. And that's why year two, that goes up. And then other stays pretty flat. But the thing is about other income is there's no cable contract. So day one, I expect probably a $15,000 influx because that's what we did at Candle Ridge with Comcast. There's no cable contract, but these cable companies pay per door to have exclusive rights. And then they pay quarterly promote for having services for your customer, for your residents. We talked about washer and dryers. That's not part of this. Reserve parking and doing more on increased parking, administrative fees, all these other things. What I like to do is I don't want to put everything in the underwriting because something's going to be off. Maybe my revenue number, maybe my cap rate, and that's okay because we have all these other things that are, not in the underwriting. That's gravy that will help offset anything that may go wrong, right? And that's just part of preservation of capital and making sure we can all sleep at night. All right, we'll go to the next slide. These expenses on the next slide are very in line with what we typically see across our portfolio. Between the property management fee, G&A, contract services, marketing, you'll see that a lot of the expenses are even higher than the seller because we don't budget based on seller. For example, I don't know how they have one person or in the office, one person out of the office for only $125,000. It doesn't work. Really, to have two full-time people, which is what we would need for this type property, is about $170,000. That includes bonuses and everything else. So we're a little less than, it's about $45,000 more on payroll because we're budgeting and doing what is going to be needed for the property to bring in the right people. Now, insurance, when you buy a property, you typically have to, part of the closing costs, and maybe one of the reasons like, why is closing costs so high? It's because you also have to pay your first year premium on insurance. And so they calculated that in their T12. So they've got their year one, which is they're escrowed, and then they pay, but then you also have to pay year one insurance. So it is higher, which is why it's higher on theirs, but our insurance quote has come in. We feel very confident in it, but this is a number that's very important. The other thing about San Antonio that I love, there's always going to be increases in insurance, but you don't have major hurricanes. You don't have major storms. Hail that's everywhere. Everybody knows that in Arkansas. Like at the end of the day, like those storms, they come everywhere. But that insurance quote is solid. One of the things I get super excited about in every deal, the last 3 deals I've done, it's just easy money. So notice on real estate taxes, they paid $312,000 on annual real estate taxes. Because we're buying $800,000 less than the tax appraised value, I'm pricing at $10,750,000. I take that $10,750,000 and I multiply it by the mill rate, the tax rate, to get me 100% of that $245,100. Day one money, I'm not paying $312,000 in real estate taxes like the prior owner, because remember, they bought it $3 million more than that we're buying. Our taxes is $245,000. That's a guaranteed. We will not pay more than that this year. And then I've got modest increase. I go 245 to 252. There will be increases down the road, but it sets back. So I think it's a major win for our property. The other thing down here I want to show is cash on cash. I want to show net cash flow before tax. So at $250,000. But look at this. The debt service coverage ratio is 1.75. So for every $1 we pay in debt service, there's 75 cents we can pay in other expenses. Fannie Mae requires $1.25. And if y'all are on any deals in prior years, you might have invested in a deal that was 1.0, but they had all these reserves and there was a plan on value add and all that. This deal is 1.75. I would have to be, let's look at the break even, I have to be 66% occupied to break even. That's incredible. I have to really suck at what I do and what we do and lose a bunch of tenants. And we're not going to do that. But my point is, that is how because I'm investing in here personally too, just like all of y'all. We're all investing together, but that is peace of mind. That's 66%. That's all cash flow, 250,000. If MLDC even gets half of what they think they're going to do, so instead of that 1,557,000, maybe they're 1,525,000, still higher than my number, but lower than theirs. That still juices that service coverage ratio, boosts the returns. That break even instead of 66 could be 64. At the end of the day, like the numbers are just going to go in our favor. If we go to the next slide, also on that back slide, you don't have to go back to it, but you'll see the debt service coverage ratio drops year 3 because remember, year 2, I only underwrote interest only for 2 years. That may be a 3-year interest only. So you'll see a drop. It goes like to 2.0 DSCR and then 1.75 in year 3. And that's because the interest only dries out. All right, we're almost done. We have a few more slides. Let's talk numbers. So we have 3 asset classes. And what I find with our investors and with Dr. Bio investors is there's investors that really want cash flow. They don't really care about the equity upside, but they love the cash flow and they love the tax depreciation. So we created a class A, and we've done this on the last few deals. It's a 500,000 max class of investment with a minimum of 250,000. So if you do 250,000, I'm just going to make numbers simple here. 250,000 at 10%, you're paid 25,000 a year. So on a quarterly basis, I believe that's 6,250. I'm just throwing out my head there. But anyway, there's that cash flow every quarter is where that number comes from. Now, if you're investing the 500,000, 10%, that's 500 or 50,000. That 12,500 or so is going to be paid on a quarterly basis. What's incredible is, and I can put you in touch with one of my investors because he likes to do this, and he gets this tax K1s at the end of the year, which is now. And I kid you not, he's got over like 400,000 on K1 losses because he's invested with several of our deals. He makes over 160,000 on passive income. And so he doesn't pay any taxes. When I go visit him in Los Angeles, like his income is all passive. He's a retired cardiologist. His income is all passive. And then he has the depreciation that offsets. Now there will be probably catch-up tax down the road. But anyway, that's another story. But for now, like he's not just living, that 106,000 is straight up pure cash flow because of depreciation. So that's why a lot of people love this asset class. Again, 250,000 minimum, 500,000 max. If anybody on this call is interested in this, I would move tonight on it because we have Dr. Bio mentioned Raj, and then I have an event. They love this. But anyway, if we go to class B, the class B is a minimum of $100,000. Most of our investors and Dr. Bio investors do the 100,000 because of this. It's an 8% preferred return, meaning we don't get paid anything until that return is 8%. So maybe year one's 4%. That other 4% accrues to the next year. All that money gets paid first to those investors before it gets paid to the partner. So say that 8% pref, but what's amazing about it is once we sell the property, the split is 80-20. So 80% return to the investor, 20% to the general partner. So not only do you get a better preferred return at 8%, but you get an 80-20 split. And so this has worked really well for us. Anything over 18% IRR though, it's split 50-50. And again, you want to see that alignment with sponsors that, hey, we're going to overachieve, overkill. So that way we can have a lot of juice at the end as well. And we get that over an 18% IRR. The Class B investor IRR on this is 16.56%. The investor equity multiple is 2.05, and the average annual return is 20.93. So even though I'm mentioning 8% or I mentioned a 4% return year one, when you look at all the returns that you're paid during the hold cycle, and then when we sell, when you take all that combined, the average annual returns is over 20%. And that's where people really get their wealth in real estate. When Dr. Bio is talking about wealth in real estate, it's not necessarily the $4,200 a year and such. It's the equity sale, it's the refinance, it's the capital infusion that happens during those major events. If we go to the Class C and anticipated returns, now this is a $50,000 investment. Now we made the numbers simple here at 100,000 on the, but I think $50,000 is the minimum investment. We have a lot of investors who maybe can't do 100,000, so they'll do 50 or 75. So they sit in this class of investment, and it's still solid. It's a 7% preferred return and a 75-25 split. So 75% goes to the general partners, 25% goes to, 75% goes to limited partners, 25% goes to the general partners. Similar structure, after 18% IRR is split 50-50, but the Class C investor IRR is great. It's 15.47%. Investor equity multiple is 1.96. And the Class C average annual return is 19.12. And so if you take this 4,200 or whatever, and you divide it by 2 and get the 50,000 just for easy memory, I just made it easy here just to follow through on the 100,000. But again, this is the minimum investment is 50,000. And if we go to the next slide, we need to know, like, we have no idea where cap rates are going to be in tomorrow even, or a few years. A lot of that's driven with interest rates. We've seen cap rates increase as interest rates have increased. What we're seeing right now, though, is the 10-year treasuries are going down. And I believe, things may change, but I believe interest rates over the next 5 years will go down. I think we're already seeing it. I think we've hit the bottom market, even with all the stuff that's going on in the world this past week. I don't think in real estate terms, maybe the stock market, who knows, with equities, but with real estate, I do genuinely believe we're at the bottom. And I believe that as things start coming back up, cap rates are going to be compressing because there's going to be more money being put into the market. More money is going to be wanting to invest on Main Street than in Wall Street or diversify out. What I say in one of my videos, and I push this a lot, is in real estate, we don't have to worry about Elon Musk tweeting. I don't have to worry about geopolitical stuff going on. I don't have to worry about Ukraine. I don't care. I care about that as a person, but from a real estate standpoint, it doesn't impact my rents. The value of the property doesn't drop 30% in a day because it's all driven on income. So when we look at sensitivity analysis, I say, okay, we're going to be for 100,000, we're going to be about 16.8% IRR. What if the IRR or the cap rate goes up? Say the market adjusts and I'm off base, and say it's 6.25 or 6.5, like it's still good returns. 14.2 and a 1.9 equity multiple. If we go down, if it's 5.5%, that's 2.2 or an 18.2% IRR. So these IRR sensitivity analysis, I feel like are really important to see, hey, our underwriting, our cap rate is based on where CoStar feels like it's going to be in 5 years. That's how I get that number on my cap rate. They're the most knowledgeable, in tuned with what's going on in the markets. both at a national level and a local level. And we pay good money for that data. So I'd base it on that. However, if they're wrong, which means I'm wrong, these things could adjust. And overall, I'm happy with those returns over a 5-year period. All right, if we go to the next slide, this is the 50,000. So similar thing where we're at 15.7%-ish, 14.4, or it could be 17 or 18%. But the sensitivity analysis just gives you some buffer on what low, high, and where we feel like we can achieve. Again, if MLDC is pushing revenue where they think they can push, then those values go up. But at the end of the day, I just like sleeping at night. I like everybody feeling, okay, we're overachieving, et cetera, and investing and growing all together on future deals. So this is a timeline. This is we got a couple more slides here. The timeline, so we're under contract. Due diligence has already happened. We did our first launch of our investor webinar on the 10th, which today, and then the PPM availability comes out on Monday. So the attorney has sent us the PPM as of today. So we're going to go through that and then upload it into the cash flow portal. And so the legal documents, the subscription and the company agreement will be available Monday. We're going to start accepting funds Monday through May 30th, but it's really important. And I'm not just saying this just to say like soft subscribe as soon as possible. I did my investor webinar on Tuesday and we're already subscribed for our portion. Dr. Bio has his own portion. This stuff is going quick. We've got people that are raising next week and they're already getting investments. If you soft commit, it doesn't mean you're committing fully. It just puts your place in line so that way it doesn't oversubscribe and then you just have to wait till the next deal. So just be mindful of that. Talk to Dr. Bio, about soft committing, but we'll have the funding date. You have till May 30th to fund because we're going to be closing in early June. And now, mind you, you're not in the deal until you sign the document and you wire the funds. So even if we oversubscribe, which I fully expect us doing, if you were subscribed and you didn't fund the investment timely, then the next person who does that faster is going to be in the deal. So just be mindful of that. This is a 506C offering for accredited investors. If you're not sure if you're accredited, I'll give the accreditation by definition from the Security Exchange Commission. If you file single and you have an income of 200,000 or more, you're considered accredited. If you filed your taxes as a joint married person, so if you're married and you file jointly, that's 300,000 in income or more, joint marriage. Or if your net worth is over $1 million, excluding your home residence. So if you have other rentals, you have other investments, your car's paid off, all that part goes into your net income. You've got stocks, you have 401k. If that is over $1 million, then you're accredited. And we use verifyinvestor.com. It's an easy upload, your financials. Dr. Bio and I will never see your financials. It goes to a third party. And then all we do is get a letter. It's a paragraph says that you're accredited. The other item is you can have your CPA do this. So a lot of you and myself, we have CPAs. They can provide that letter as well. But I find that a lot of people use verifyinvestor.com. It's fast, it's easy, and provides that letter so Dr. Bio can get it. We can get you moved into the investment faster. So with that, I believe that's one of the last slides. And obviously we'll want to open up Q&A.
That's it. Yep. Thanks, Wayne. We wanted to make sure that we explain every part of the deal, that you understand what you're going to be investing in. So that's why it's important that we go through every single of these slides. So like you said, we don't do any deal. When the market is rocky, we learn from experience. We put our pencil down. We continue to underwrite and look at deals, but I'm not in a rush. I get to enjoy my clinic until a good deal comes along. So this year is going to be our first deal. We don't know when the next one is. We continuously send in offer, but like Wayne said, oftentimes it will be 1 million over that they want. So we're like, no. Any questions? I think there's one.
Yeah. How you doing? This is Randy calling over from, it's Randy talking over from Jersey. I know you mentioned a website for accredited investors. Now, if I'm already investing in like hedge funds and stocks, things of that nature too, you guys still do want that, a lot more money.
Yes.
But you guys still do want the
Yes.
other parts. I don't know if there's if they provide me with something to give to you guys, or however the case may be.
Yeah, you just uploaded that website. You pay a little fee and it gives you, the reason is, Randy, it's a really great question, is we do get audited by the Security Exchange Commission. And so it's not our rules, it's their rules. And it's because we're publicly advertising as security, you're buying a security. And I just am scared of the feds. So get that letter. All it is, but it's such an easy process. So if you have a statement or something and you just upload, we will not see that document or your financials. All we get is a paragraph, and then we upload it into the investor portal, just in the slight chance we do get audited. So that's the reason.
Okay, and just to confirm, I know MLDC Management is the management company you will be choosing to manage the property, right? But
Yes.
the conglomerate is is it under Dr. Breathe Easy Capital, or is it, what's the name of the conglomerate altogether, or is it a different name?
Yeah, great question. So the property on the deed, yeah, that's a great question. So the property on the deed is CREI Multifamily 12324 owner LP. That's the ownership entity for that property. And then within that ownership entity, you have your general partners and your limited partners that go into that. So when you sign a company agreement, you're going to be signing the company agreement to the CREI Multifamily 12324 LP, owner LP. And then that's the entity that's going to hold deed to the property. So that's where you're like, okay, I'm part of a company. I'm a limited partner in that company that owns that asset. And so that's how you know that your money and everything is going to a legitimate investment in real property. And then we third party management. There's a lot of companies that integrate it in-house. I don't like that because if I have a manager sick, I don't have the scale to like fill in that manager, or if there's an emergency. I also like that it's arm length distance. So there's not going to be fraud when it's a third party management company. I don't have any worry that I'm going to do fraud or Dr. Bio, but it's just that arm length distance. I think from a passive investor, I think it's important. I feel good telling people like, hey, a professionally managed company is going to manage this asset on behalf of that CREI multifamily entity that owns the property. Yeah. So Adebayo, we're going to be more GP members.
Okay. And I'm pretty sure they're highly vetted. I'm pretty sure you worked with them before, the management company out of Houston.
Yeah, they've managed 3 other properties for us.
Got you. So what are some of the benchmarks and barometers you want from them? Because we all pretty much know that the management is make it or break, especially when it comes to multifamily. What are some of the things that you look for out of the management companies, and how are we making sure that they are keep raising the bar with the different properties that you have?
Yeah. So this is a great question too. Every day I get a KPI report on my entire portfolio. It's the first thing I look at. Usually when I wake up and relax or whatever, I'm like looking at my KPIs. So on that, we look at occupancy, loss to lease, down units, collections, all that. It takes it from the management software and then it extrapolates into a 2-3 page document where I can run it by daily. I mentioned we have a full-time asset manager. His job is to ensure our performance of properties. Like I want to be 95% or over on all our properties. Sometimes it's 92, 91, 95 is our goal. A lot of those people, a lot of you on the call invested in Candle Ridge. We've averaged about 98% or higher with MLDC. The other barometer that we look at is bad debt and evictions. So if they're bringing in a bunch of people and then 2-3 months later we're evicting, like that's no good. Yeah. And so what we see, and it sometimes annoys the heck out of me because I'm like, man, we got all this traffic. Why are we turning leases? And the reason is because they're following their protocol. Like you have to show proper citizenship or proper documentation. You have to show income. There's a lot of fraud with checks or pay stubs. And so they're calling the employers and such. So that's something that's really important for us that we track. Downtime on units, it shouldn't take more than a week to turn these units. If it does, that's for my KPIs. We manage that. The other thing we're looking at is like all the rentals should not be coming up for renewal in the summertime. It needs to be split out over a year. So that way we always have 3 or 4 coming up for renewal. So we're not stressing in the summer. Those are things that MLDC takes care of. Now, vice versa, there was a management company, and I won't say who it is, it's on recorded. But I think I mentioned earlier, they had 20, the regional had 20 properties that they saw, and they just couldn't handle. I felt like a little man in a big pond for them. They're giant. So MLDC, they like, I have nothing but good things to say. Are they perfect? No, but it's our job. And I was telling Will, my asset manager this week, I'm like, hey, they really shouldn't call you an asset manager. They should call you an asset leader. Because at the end of the day, like our job is to make sure that we're the helicopter guy, making sure the management company is doing their job and leading them to where we need them to be. Because they're not always going to have the big picture strategy, and that's not their job, but that's our job as asset managers.
Okay. And also, I know you said if you're doing 50,000, it's 7.5%. Anywhere if you're around 100,000, it's guaranteed 8% on
No,
that.
yeah, great question.
We never say the word guarantee.
Yeah, nothing's
There's
guaranteed.
nothing guaranteed. Yeah, of course, in real estate, right? I
But
got
it's
you.
7%. Yeah, 7% preferred for
Preferred.
Class C,
Preferred.
and then 8%. But the difference on that, Randy, is the split. So once we sell, 80% of the profits go to the Class B investors, 75 to the Class C. And so that's really the big difference. But how the preferred return rate works is before the general partners get any cash flow from the deal outside of the asset management fee to help keep the lights on, the 7% or 8% has to be paid to you in full, and it accrues. So if year one doesn't hit 7%, it accrues to the following year before we pay out. And it may take to the sell of it to get you fully whole. But once you're whole, then we then get the remaining split.
Okay, and generally a project in a property such as this too, typically how long do you guys hold it? I know there's a 7-year, so how long do you usually hold it on it?
Man, I love these questions. So it's 7-year loan, but we want to sell in 5 years.
Okay.
If we could sell in 4 years, if we get a great offer, great. I'm not one of those guys who wants to sell in year 2 because we love the cash flow. Finding deals is extremely hard. And getting that tax depreciation and getting cash flow is great. So about year 4, we'll start looking to sell. Year 5, we will definitely sell. It's a 5-year hold. However, I always do a 7-year loan because what if year 5 is not a good market? It gives us time. We're not stressing that we have to sell. And so, yes, we pay a little premium on a prepayment with the lender. It's typically 1%, but it gives us flexibility. And I think a lot of people are in trouble right now because they don't have that flexibility. They did a 3-year loan or a 5-year, and they didn't give themselves a buffer. For us, and that's in the underwriting, it's budgeted for, but it just gives us a couple years if the market isn't ideal in year 5. But year 5 is what I get impatient after year 5. I'm like, I want my money, like I'm ready to go. But yeah, year 5 is what we would all hope for.
You guys have been rocking, and you've been even beating that 7 or the 8%. I know you mentioned, I forget what number you were saying, but it sounded like you guys were even outperforming doing that. So.
Yeah, and the average annual returns, when you look at the wholesale of everything, we anticipate 19 to 20% total average annual returns. And that's where when you go on Facebook, if you see these huge returns and you may compare like, why are these low? It's because I don't want to get you all excited about 18, 19%. And then you'd be like, first quarter, I only got 1%. What's up? And I'm like, no, it's the whole picture. And that's where I feel like some people, they advertise and they just get it a little, it's like just yeah, it is the whole, that is accurate, but it just encompasses the entire cash flow distribution from start to finish.
Okay. Thank you. I don't take up too much time. I appreciate it.
No, you're good.
I have a question though.
Hey, how are you?
Can you hear me?
I hear you, yes.
Oh, okay. In your projection, you have 3 to 5% rent bumps assumptions on an annual basis. So one of the apartments that I'm currently investing, basically they have to renew.
Volume popped off.
Can't hear you.
Hello?
Oh,
John, we can't hear you.
You can't hear me?
Oh, we can hear you now.
Okay. So you had a projection of 3 to 5% rent bumps in your assumption on the writing. So one of the apartments that I'm currently investing in right now, basically they had to renew like tenants that their contract is expiring at a very flat rate. So my question is, how do you plan to hit your objection if your business strategy ever changes and you can't hit that 2 to 5% rent bumps? I think I had another one, but skip my mind. But if we can start from that.
Yeah, it's a great question. So the underwriting that I have that showed is 3%. I do think we can get 3 to 5%. But if I look at an $800 rent, the rent increase at 3%, I just did the quick math, is $24 a month. And so what we do is we talk to we've always, on our portfolio, we typically see 5 to 7%. And how we do that 3%, that $24, if you annualize that over 12 months, it's going to cost them more to move than stay in the property. That's one. And two, with all those other rent comps, if they were to leave, they're going to be paying more than where they are now. So why people really leave, they'll pay $24 more a month if the pool is blue and not green, if the manager is treating them well and everything is upkept. It's just like anybody. Like if the property is good and I feel safe and comfortable, I'm willing to pay $24 a month. But if the market does slow down, and that's why I kept my overall revenue at 1,490,000 something, instead of the manager's number at 1,557,000, the way we're projecting is we have to do worse. Like we're projecting lower income than the current owner on T12. Yeah. So you're absolutely right on, hey, what maybe could happen. In my mind, I feel like we can get a $24 rent bump, but what if we don't? And that's where I'm like, hey, I at least know my revenue should be at least what they made last year, and my underwriting is less than that. So that's where in my mind, I'm like, okay, there's adjustments. The other thing too, when you look at the underwriting, and if you're a numbers guy, I can share the underwriting with you, but you'll see loss to lease and you'll see vacancy, you'll see all those things. So even though there are rent increases, there's levers that make it more conservative because we're budgeting loss to lease, we're budgeting bad debt, we're budgeting concessions, we're budgeting vacancy. And so that's where we are on that. So that's why I feel pretty good about it. I think the overall basis, the loan is 6.9 million versus today's loan at 10.1 million. And just the basis of us like buying $3 million less than what it was last year, we're not really even taking into account just the value of just day one ownership of a property that recently appraised, and some lender and appraiser appraised it a year ago to get the current loan that they have. So all those things I feel like help me sleep at night. Hey, are we being aggressive? I don't think so. But in a worst case, we're budgeting less money than what the current guy is currently doing. And sounds like he's in distress.
Okay. But what's your stabilization period and how frequent do you pay distributions?
Stabilization's day one. We'll pay our first distribution first quarter. Yeah.
Okay. Usually every quarter. Yeah. We do every quarter. We always say 6 to 9 months, but looking at the fact that this deal looks like the last one, the candle range, even a little bit better. So we expect to get it earlier. So I'm going to also piggyback on what Wayne said about concessions. Some of the concessions already put into the underwriting also. Sometimes you might have to do a concession to get people in, 13 months to get in, pay 1 month free, get 13 months. So some of the concessions already there. Also, we have vacancy of 10% for 5 years. Almost all the ones we have, it's 95%. I think Candle Ridge is like 197. So,
yeah,
they are all high. You said?
Yeah, we've been about 98.
Yeah, but then we underwrote for 10%. So even if you get that, and then you have to do a little bit of concessions for those 8% next year, it will still be equivalent to that. That 10% give you a lot of buffer. So many people would like to underwrite with 5%. By the way, John also is a syndicator. So he does this too. So he knows usually most people underwrite with 5% vacancy. That's usually the very common one. Bigger pockets does that, but we do 10. So
I think it's a very nice deal. I love the leverage on the deal. So I love it.
Yeah, we appreciate that.
I know we have taken a lot of you guys' time. If you have any more questions, most of you are in my group, or you can just email. I'm always available on LinkedIn. Find me, and then tell us if you're interested. We send you the link to reserve, and then we go from there. Okay. So I think this is a good deal. I personally will be investing in it. I'm one of the key principals. Me and Wayne were on the loan, which means something happens, they're going to be calling us, not you. So I won't put my name, the money that I've worked out to do on a deal if I don't think the deal have a very high probability of making it to the end. because I'm not in the business of doing that sniper shot and losing that money. So I take it. So I take my time. I might just do 1 deal, 2 deals a year. I'm not one of those syndicators that do like deals every month. We all know those. There's always another deal before another one. So just take your time, find the best deals. And because we do have other source of income. So we're not, at least, sorry, Wayne, but I'm saying I'm not personally in a rush to jump into deals. But this one's a good one.
And just know, like, my whole life, so I served in the Marine Corps 2003 to 2007. And so in 2007 to current, my whole life has been commercial real estate. So many doctors and people are here your whole career. Like, I didn't come from another industry to come in here. This is all I know, all I think about. Anyway, so I appreciate the trust and the partnership and for partnering with us, Dr. Bayo and the team.
Okay, sorry about that. It seems like the kids already bedtime. Okay, take care, guys. And then if you have any more questions, reach out to us. Have a good day.
Thank y'all.
Bye.